Joining us now to discuss, PIMCO North American economist and managing director Tiffany Wilding. How do you think the Fed is going to take all of the data and the news we've gotten so far, and what do you think they're going to do in May?
Well, I mean, I think that what they're trying to do right now is just weigh the elevated inflation risks against the financial stability risks that you talked about. But I think one of the issues here is obviously these things are not mutually exclusive. It does look like financial stability risks have been somewhat stemmed as a result of the new lending facilities that the Fed has put it in place, which has kind of created has increased confidence in the banking sector. But nevertheless, banks are going to respond to this, as you guys have just been discussing, by probably reducing the flow of credit. It's really the flow of credit here, not the stock of outstanding. And you don't need a deleveraging episode to get a recession. Obviously, slower credit growth will eventually put downward pressure on inflation. So I think it's really just a matter of time here before inflation comes down. But of course, inflation lags. So for right now, it probably does look like they're going to get one more hike in, before they really start to see the effects of this banking sector stress.
So where do recession odds for you at PIMCO stand, given all these changing factors?
Yeah, I mean, we think we've been in the camp that recession's more likely than not this year for quite some time. Interestingly, if you just take a step back, and we've looked at, over 14 developed markets over the past 70 years, what happens to economies when central banks start hiking? And what we find is that 6 to 8 quarters after a central bank starts hiking interest rates, you tend to see more material deterioration in an economy. So really, although that analysis didn't forecast these specific banking stresses, the timing's kind of lining up with that. So I think it's overall just reflective of the fact financial conditions are very tight. These things happen with a lag, and ultimately the speed at which the Fed has moved over the last year probably will, bring the economy down into a recession, I'll bet somewhat modest one.
Interesting. The Kansas City Fed had a great paper last week looking at why it's taking so long for monetary policy to have transmission mechanisms that are effective. And a big part of it is that with services being such a big force of inflation on the labor front and on the pricing front, those are things that are not usually financed. I mean, how is the Fed, do you think, thinking about the fact that we are trying to solve one problem, but we're making things very tough on specific corners of the economy in the meantime?
Yeah, well, I mean, obviously the Federal Reserve, when they increase interest rates, doesn't affect everything all at once and at the same time. You tend to start to see that in the interest rate sensitive sectors, obviously housing in a deep contraction over the course of last year. That eventually will spill into services. And the tech sector layoffs that have been a lot of people have been focusing on, we actually think those start to show up in the government data in April, as a result of these warn notices that would suggest that that's when they're going to show up. And then ultimately, as that trickles down into the lower, less spending on services, that would also weaken labor markets for those, leisure, hospitality, travel services sectors as well. So all of this stuff just happens. It just takes some time, happens with a lag. The Federal Reserve has to understand that when they're hiking interest rates.